A financial derivative is a security whose value is entirely linked to the performance of an underlying asset. These underlying assets form the foundation of the contract, typically consisting of equities, government bonds, or physical commodities like gold and crude palm oil. While private parties can negotiate flexible over-the-counter contracts, the institutional framework relies on exchange-traded derivatives. These are standardized instruments facilitated by a centralized hub to ensure market transparency. These markets do not trade physical goods. They trade mathematical links to those goods, allowing participants to isolate and transfer specific financial risks. The exchange-traded market is built upon two primary classifications: futures and options. These instruments solve distinct market problems because they engineer risk in two entirely different ways. Futures contracts manage symmetric obligation through strict daily accounting, while options contracts price asymmetric rights through the collection of upfront premiums. Understanding the mechanics of the derivatives market requires dissecting these two contrasting approaches to counterparty risk. A futures contract is a standardized, binding agreement to exchange an asset at a predetermined price on a specific future date. This agreement represents a strict legal obligation for both the buyer in the long position and the seller in the short position. In the Malaysian market, crude palm oil futures, or FCPO, trade in standard contract sizes of 25 metric tons. This linear payoff structure means a 100 ringgit price increase per metric ton yields 2,500 ringgit in total profit for the long position, with the short position simultaneously incurring a 2,500 ringgit loss. Because the financial gain of one party dictates an exact equal financial loss for the other, the contract creates open-ended symmetrical counterparty risk. To manage this exposure, the exchange utilizes a clearinghouse. This entity acts as the universal counterparty, breaking up direct buyer-to-seller exposure and guaranteeing all trades. The clearinghouse requires an initial margin, a mandatory cash deposit to open a position. For an FCPO contract, this baseline is typically 5,000 ringgit. Once the position is open, the exchange implements a mark-to-market process. Contract prices are adjusted daily, and actual cash settlements are executed between accounts at the close of every trading session. To maintain the position, a trader's account balance must remain above the maintenance margin, a threshold set, for instance, at 4,000 ringgit. If an FCPO price move causes a 2,500 ringgit loss, the account balance drops to 2,500, breaching the maintenance line. This triggers a margin call, an immediate cash call to restore the account to the original 5,000 ringgit level. This process forces market participants to prove they can afford their symmetric obligations in real time. Options operate on a different logic. An option contract grants the right, but explicitly not the obligation, to transact an asset at a pre-specified strike price. Call options provide the right to buy the asset, while put options provide the right to sell it. To acquire this right, the buyer pays the seller a premium. This is an upfront, non-refundable fee. For a call option on Johnson & Johnson stock with an 89 ringgit strike and a 2 ringgit 17 cent premium, the buyer only exercises the right if the market price exceeds their total cost. If the spot price reaches 94, the buyer clears a net profit of 2 ringgit 83 cents. By paying this premium upfront, the buyer severs the symmetric obligation and caps their total downside risk at the cost of the fee. This payoff diagram shows the structural asymmetry for the buyer of a call option. The risk is strictly capped at the horizontal depth of the premium paid, while the profit potential extends indefinitely as the asset price rises. The call option seller faces the inverse profile. Their maximum profit is strictly limited to the premium collected, while their loss potential slopes downward indefinitely, reflecting their obligation to deliver the asset if the buyer exercises the right. Put options invert this relationship. The put buyer's profit increases as the underlying asset's price falls below the strike price, as shown by the upward sloping line moving left. Conversely, the put option seller's upside is capped at the premium, while they face a steep diagonal loss as they are obligated to buy a depreciating asset. Option sellers operate much like insurance companies, accepting these theoretically open-ended risk profiles in exchange for guaranteed upfront income. Mapping these contracts onto a single matrix clarifies the disparity. futures assign obligations to both parties, while options assign a right to the buyer and an obligation to the seller. The symmetrical risk inherent in futures requires the daily marked-to-market margin system to remain viable. The asymmetrical risk in options relies instead on the upfront exchange of the premium. This framework also allows for different exercise styles. American options allow execution at any time before expiry, whereas European options are restricted to the expiration date itself. Market participants choose between these instruments based on the need to lock in a future price or simply purchase the right to participate in one. Both futures and options serve as tools for hedgers seeking to manage volatility and for speculators looking to capture it. Every settled contract represents an engineered transfer of financial exposure. Navigating the derivatives market requires a command of this underlying architecture, the precise engineering of time, leverage, and structural obligation.